The Indian government financial package to address slowdown in the economy with an impending danger of even a negative growth rate largely neglected income concern of customers and seems more in concern about increasing liquidity in the system through host of credit guarantee programs. Due to lockdown 19, economic activity is halted. Businesses are not having money to operate their businesses. The customers have lost their earnings. At the time of this such demand, it will be difficult for corporations to repay their present dues. Adding more loans will make things worse. This will add more NPAs into our banking system, which is already troubled with growing NPAs. Total NPAs with public sector banks stands at 7.27 lakh crore on September 2019. MSME, or the micro, small, medium enterprise. The sector contributes 29.7% of our GDP. It accounts for nearly 40% of gross value of output in manufacturing sector and 50% of total export from country. There are over 6 crore MSME in India, and out of which 51% are functioning in rural India and 49% are in urban areas. The urban MSME are giving employment to 55% of total employed in the category. Almost all MSME falls into micro category. Only 0.5% are medium and small enterprises. The sector has serious issue in access to credit. A 2018 report by IFC finds only 16% MSME gets finance from formal sector. Rest are either underfinanced or get it from informal sector at high rate of interest. They don't have assets and have to take credit against property. At the time of slowdown, even property rates go down and make it difficult for them to fund them. According to TransUnion Civil, NPA with MSME stands at 12.6% in December 2019 and loans worth 2.3 lakh crore are at risk of becoming an NPA. Strangely, an amount of 5 lakh crore is unpaid by various government departments. To address credit concern, the government announces a couple of measures in financial package. Rupee 3 lakh crore worth of working capital loan with a year of moratorium on principal payment, fully guaranteed by central government with a tenure of 4 years. The amount of credit will be 20% of outstanding credit on February 29, 2020. According to SBI research, the total outstanding as on March 1st was 14 lakh crore. The scheme will benefit 45 lakh units and will cover existing borrowers with outstanding credit limit of 25 crore and turnover of up to 100 crore. The second proposal is a 20,000 crore subordinate debt for more than 2 lakh stressed MSME. Stressed MSMEs are MSMEs with poor credit history and for whom getting credit is difficult and costly. Subordinate debt is a debt which is paid after senior debt is paid in full. This is partial guarantee scheme where government will support with 4,000 crores of credit guarantee trust for micro and small enterprises. The amount will be equal to 15% of promoter stake in firm and maximum up to 75 lakhs. A 50,000 crore fund for new firms with limited option of funding. Government will set a fund with a corpus of 10,000 crores made up in PF funds insurance companies. Will encourage MSMEs to get listed on main board of stock exchange. The fund proposes to buy 15% of equity with a high credit ratings MSME. A fund of fund is a sort of mutual fund which invests in other mutual fund rather than in stock or bonds directly. The government has also revised the criteria of classification of micro, small and medium enterprises. The change in definition will help them grow. In fear of losing benefits, the firms are not growing. The idea here is to get some funds for MSME which are in trouble due to lockdown and don't have money to cover the expenses. The bank will give loan as a risk of default is transferred to government. In credit schemes, the liability will arise when default will happen. The sector needs direct help in form of wage support and relaxations. Arranging labour for work will be another challenge as labour is going back to their hometown. Government will not allow foreign companies to bid for contract value up to Rs 200 crore. This way they want to push concept of Make in India and will safeguard MSME sector at the time of economic slowdown. Protectionism may sound good but will not benefit industry in long run. Checking competition will promote inefficiencies in the system and may hamper growth of these companies in the long run. MSME get 21% of credit from NBFC or the non-banking finance company. NBFCs are the companies which functions like bank but don't have a banking license. A NBFC cannot accept demand deposit. A demand deposit is a deposit which you can withdraw at any time. Typically, the money in your saving bank account in the current account. They do not form part of payment and settlement process and cannot issue check drawn on itself. Deposit insurance facility of Deposit Insurance and Credit Guarantee Corporation is not available to customers of NBFC. A microfinance company provides small loans, typically less than 1 lakh in India, to low-income people who do not have access to banking facility. A housing finance company, as the name suggests, engage in extending credit for buying or construction of a house. These NBFC raise money by either borrowings from commercial bank or by selling commercial papers to mutual funds. A commercial paper is a short-term unsecured debt issued by corporations to meet their short-term debt obligations. NBFC bears greater risk as their clients are mostly from informal sector and self-employed people. Their NP stands at 6.3% in September 19 and they own 8.07 lakh crores of bank. Most of NBFC face problem of asset-liability gap. An asset-liability gap is created when your liabilities are more than assets, or when you borrow for a short term but lend for long term. In normal times, it is revenue it's possible to pay that liability, but during troubled times it's difficult to repay your dues. NBFCs are playing very important part in economic growth, but these companies are in trouble after a series of defaults by IL&FS. Banks and mutual funds are not extending credit to NBFCs. This forced them to borrow from informal sector at high cost. Due to COVID-19 related lockdown, an increase in loan default is expected. This will aggravate cash concern of the companies. The government has announced a special liquidity scheme of Rs 30,000 crore, where investment will be made in investment-grade papers of NBFC, microfinance institutions, and housing finance companies in primary and secondary market. A special purpose vehicle will be set up by a large PSU bank, which will issue bond guaranteed by central government. Reserve Bank of India will purchase them. The money will be used to buy debt of investment-grade papers of NBFC HFC of short duration, that is for residual maturity of up to 3 months. Investment grade is basically ratings signifying low risk of default. Government implication will be 5 crore, which may be equity contribution for SPV only. There are no financial implication for government until the default happens. A 45,000 crore worth of partial credit guarantee scheme for AA or low-rated or unrated firms with original maturity of 1 year. Rating shows credit worthiness of NBFC. A high rating defines low risk, where low rating defines high risk. The bond commercial paper will be purchased by state-owned banks. The government guarantee of 20% of first loss will be provided to the state-owned banks. First loss guarantee means in case of default, 20% of the amount will be paid by government. The total cost to government will be 9,000 crore. According to Moody's, the planned debt purchase is equals to 2% of outstanding debt of top 20 NBFC in India, and measure announced by RBI has benefited larger and better rated NBFC. Credit to small NBFC is less effective. Industry sources, however, apprehend that such a short duration of 3 months may lead to even bigger asset liability mismatch problem. The sector was in trouble before, and COVID-19 has aggravated it. Power Discoms, which owns 94,000 crores of production companies, will be provided with emergency liquidity bailout of 90,000 crore. These discoms are losing money due to theft, which is over 27% in India, inadequate tariff hike, non-payment of dues, which stands at 41,000 crore by June end, according to Financial Express, and competition from renewable producers like solar and wind. According to CII, the Confederation of Indian Industries, lockdown will cost them another 30,000 crore revenue loss. These steps may provide liquidity in the system, but may not revive demand, as most of the customers have lost their earnings. Most of the steps are not even sufficient, as they are for short duration. Revival of demand is must to start the economy. The measures may lead to series of default for banks and may lead to even a bigger mess with banking system. Please watch part 2 for other announcements and their analysis. Thank you.